Hi, my name is Colin Lightbody, and I'm the president and founder of HR and Labor Guru, Inc. On behalf of the company, I'd like to welcome you to our on-demand webinar series. Before we get into the presentation materials, I'd like to take a few minutes to let you know a bit about our company and also give you some insight into my professional background. First, let's talk about the company. HR and Labor Guru's goals are to provide practical, value-added, human resource and labor solutions to our clients through on-demand webinars, plus training and consulting engagements. Our company specializes in a number of areas, including the following. First is bargaining preparation and strategy formulation for labor negotiations, development of negotiations costing models and bargaining tools, identification of opportunities to reduce and/or mitigate rising labor costs, healthcare cost reduction strategies, addressing high unplanned absenteeism, including FMLA in the United States, and finally, HR analytics in terms of building effective analytics teams and identifying and executing high-value projects. Next, let's talk about my professional background. I established HR and Labor Guru in 2019 after retiring from Fiat Chrysler Automobiles, or FCA, with 20 years of service. My last position held at Fiat Chrysler was Director of Labor Economics, People Analytics and Insights, and Hourly Attendance at Chrysler World Headquarters in Auburn Hills, Michigan. In terms of labor negotiations, I have over 20 years of union negotiations experience, and I've been actively involved in numerous multi-billion-dollar deals. While at Fiat Chrysler, I was actively involved in virtually every set of national negotiations in the United States with the United Auto Workers Union since 2003, every set in Canada with Unifor, formerly known as the Canadian Auto Workers Union, since 1999, and every set in Mexico with the CTM Union since 2004. My roles and responsibilities ranged from being a bargaining subcommittee chairperson to benefits accounting, labor economics, and labor strategy expert, to negotiating with presidents of the national labor unions. In 2007, I participated in the negotiation of the transfer of Chrysler's multi-billion-dollar retiree health care obligation to a United Auto Workers Union-sponsored healthcare trust. In addition, over the years, I was actively involved in facilitating several special agreements, including corporate restructuring deals pertaining to shift eliminations, plant divestitures, and plant closures. In my opinion, though, my biggest claim to fame is the fact that for many years, I provided strategic bargaining guidance and worked directly with the late FCA Chief Executive Officer, Sergio Marchionne, arguably one of the best negotiators of all time. Also, I was a member of the Mercer Labor and Employee Relations Network in the United States for over 10 years. Therefore, I had the distinct pleasure of networking, benchmarking, and sharing best practices with some of the world's top labor executives from multiple industries on topics ranging from absenteeism challenges to labor negotiation strategies. In terms of HR analytics, as head of the People Analytics and Insights team at Fiat Chrysler, I directed numerous special studies, including the following: internal labor market maps and employee turnover studies for the salaried workforce, and deep dive studies on topics such as absenteeism and hourly hiring process for the hourly workforce. In addition, I was an active member of Mercer's HR Analytics Network, known as the Internal Labor Market Network, for over 3 years in the United States. As a member of this group, I had the opportunity of networking with some of the world's top HR analytics professionals and consultants. We regularly shared stories about growing pains, the challenges, the success stories, and the lessons learned from our unique HR analytics journeys. From an educational perspective, I'm a professional accountant, both a CPA and CA, and I was employed at Deloitte & Touche for 10 years prior to joining Fiat Chrysler. I also hold a Bachelor of Commerce degree with a concentration in accounting and finance from the University of Windsor in Windsor, Ontario, and also hold a Master of Business Administration degree with a concentration in human resources and labor relations from Wayne State University in Detroit, Michigan. So why should you attend? The preparation of negotiations, costing models, and development of robust bargaining strategies are undoubtedly two of the most important aspects of the union negotiations process. Dynamic negotiations costing models are essential in order to accurately and confidently cost out union demands, management proposals, economic offers, and overall settlement costs. In addition, since bargaining with the union never goes exactly as planned, it's imperative that the negotiation team has a clear, dynamic bargaining strategy in place in order to remain focused on the achievement of their financial and non-economic bargaining goals and objectives. So this webinar will provide attendees with a clear understanding of how to develop practical costing models and bargaining tools that will assist the negotiations team in achieving their targets. Accordingly, the learning objectives for this module are as follows. Develop an in-depth understanding of the numerous financial elements that should be considered when calculating all-in labor costs and creating negotiations costing models. Obtain a clear understanding of how to develop a dynamic negotiations costing model by utilizing a simple three-step approach that we'll go through in detail in this module. Understand the advantages of sharing certain labor cost information with the union. Learn how to develop practical bargaining tools that can be utilized to improve efficiencies when costing out union demands and management proposals. Develop alternative economic offers, and also to assist in formulating overall bargaining strategy. In addition, learn how to develop a simple matrix that will assist the company in identifying potential win-win solutions with the union. And finally, understand the importance of developing a comprehensive economic offer playbook by consolidating input from all of the various subcommittees. Who will benefit from this module? I think anyone who's at the director or vice president level involved in bargaining, whether it's human resources leaders, labor negotiations or labor relations leaders, finance leaders, or even communications team, anyone involved in the process. I think it's always good to have an understanding of the costing process. So basically any labor relation professional, and especially controllers, because they're the ones who will ultimately be booking these expenses. The first section that we're going to look at in this module are negotiations costing models. And as an introduction, basically negotiations costing models are developed in order to provide an estimate of the costs and or savings associated with the following. Union demands. So costing models are utilized to cost out preliminary union demands or anticipated union demands well in advance of bargaining, as well as being utilized for costing of union demands throughout the whole process. Also utilized to cost out any management proposals that the company has in mind, also any economic offers that are being contemplated to present to the union. And finally, it's used to cost out the final cost of the negotiated settlement. The overall assessment of the cost of the negotiated agreement is typically calculated two ways. First, it's costed on a cost per hour work basis. So basically you're trying to understand, okay, if you're going in labor costs are $40 per hour, at exit or at the end of the agreement, what are your costs on a dollar per hour work basis? Secondly, they're also costed out on a total dollars basis. So how much did that total negotiated settlement cost you? Was it $1 million, $2 million, $3 million, etc.? I recommend a basic three-step approach in building a negotiations costing model. Step 1 is to develop an hours work model. Step 2 is to develop a going-in labor costs on a per hour work basis. And then step 3 is to develop an overall negotiations costing model. So now we're going to take a look at each one of these steps in turn. So step 1 is developing the hours work model. This is a really important step as the hours work component represents the best estimate of the company's operating level over the course of the agreement. Also, it's important because it serves as the denominator in a labor cost per hour calculation. Key assumptions in the hours work model are derived as follows. First, the number of employees and overtime assumptions are typically based on discussions with operations teams, for example, industrial engineers, or any forecasts or anything available from others in the company. And often these things are based on historical patterns if there's nothing better to go on. In terms of paid time off, those assumptions are developed based on contractual entitlements. So for example, holidays, it's pretty simple for those. Everyone knows, there are 10 holidays per year, 12 holidays per year. Those are easy to calculate. Vacation entitlements and so on, you have to couple those with analysis of the workforce demographics. So since years of seniority usually drive average vacation entitlements, you have to take a look at your workforce demographics. So if half of your workforce has 2 weeks of vacation entitlement and the other half has 4 weeks of vacation entitlement, you'd have to use an average of 3 weeks for purposes of your assumptions in this model. You can also see the illustrative hours work model on a per employee basis in the chart. So at the top, you've got the straight time hours available, which is just basically 40 hours per week times 52 weeks a year gives you 2,080 hours. Then from that, you back off any vacation eligibility, as we mentioned just previously that might be an average of 3 weeks or 15 days. There's 120 hours, assuming an 8-hour day. And then you back off your holidays, assuming an average of 10 days, 80 hours there. So you get your straight time hours worked assumption of 1,880 hours. To that, then you would add an overtime assumption of 220 hours, and that would include any overtime. So it would be, premium time, paid at time and a half, double time, etc. And that would give you a total annual hours worked per employee of 2,100 hours. So if you assume 500 employees, total annual hours worked for the company in the model would be 1,050,000 hours. The second step in creating a negotiations costing model is to develop your going-in labor costs. Going-in labor costs represent the all-in cost of labor to the organization on a per-hour work basis just prior to bargaining. So by all-in labor costs, we're referring to everything that it would be paid to the employee or a benefit to the employee. So wages, benefits, and any legal required payments such as FICA and employment, unemployment insurance, and things of that nature would be included. It really represents the baseline for measuring the estimated cost of the new agreement. And going-in costs should be developed utilizing the best available information at the time. For example, the prevailing wage rates, your current demographics, the latest pension projections from your actuaries, etc. And the all-in labor cost should include the following elements: base wages, including things like cost of living allowance, if it's applicable, wage premiums such as overtime, shift premiums, team leader premiums, things of that nature, any paid time off, for example, holidays, vacation, any military, jury duty, bereavement pay, all of that should be included in paid time off. Employee benefits such as health care, pensions, life insurance, disability, etc. Any retirement benefits should also be included. At a minimum, the current service costs associated with health care or life insurance, etc. And finally, legal should be included as well. So in the United States, it would be FICA and unemployment comp. In Canada, we would include factors such as Canada Pension Plan, employment insurance, and employer health tax. As mentioned earlier, retirement-related costs associated with retiree benefits such as defined benefit pension plans and post-retirement health care and life insurance should also be considered. And as mentioned as well, at a minimum, current service costs should be considered. In some cases, some companies add in the full costs of retiree benefits, such as return on asset assumptions on pensions and interest on the obligations, etc. But at a minimum, current service costs should be considered. And as well, your accountants and actuaries should be consulted for any of these cost values. You should also consider adding an inactive factor to certain cost elements, where inactive employees, so people that are on like short-term disability, maternity leaves, etc., they may be eligible for certain benefits or entitlements, for example, ratification bonuses or lump sum payments or full vacation entitlements and so on. And it's not unusual for companies to have 5% of their workforce on inactive status at any given point in time. Another concept I'd like to introduce is the roll-up factor. A wage roll-up factor is an excellent tool to develop in conjunction with your going-in labor costs. It represents the impact of a base wage increase on labor cost elements that are affected by these wage increases. For example, overtime, defined contribution, pensions, etc. It really facilitates quicker costing of the impact of a base wage increase on all-in labor costs, rather than having to calculate the impact on overtime, on defined contribution pension amounts, and so on. It's just with the roll-up factor, you can cost it all at once. So I've put together an illustrative example on the next slide that suggests that a 1% increase in the base wage rate will increase all-in labor costs by 1.378% due to this roll-up factor of 37.8%. And for simplicity, the illustrative example on the next slide does not utilize inactive factors and does not include retiree costs. This is a pretty good example of what a model may look like. Now, this model is being built on the hours worked assumptions that we made earlier. So 220 hours of overtime, 2,100 hours worked for an average employee, etc., etc. And there's a couple different ways that you can do this. You can do it using the 2,100 hours worked on a per employee basis, or another way would be to show the total costs. So the total wages paid or the total vacation payouts expected for the entire workforce of 500 employees, and your denominator then would be the 1,050,000 hours worked. So you can do it either way. This is just easier to explain doing it on a per employee basis. So you can see the labor cost elements listed on the left-hand side of the chart, and then the first major column, you have your going-in costs, which are done on a dollar per hour basis. So the first line is the base wage rate of $25. So really this amount, the $25, would represent your composite wage rate for the company, and it would be kind of an average of your skilled and non-skilled workforce, your composite rate. The second line is the overtime premium line, where it's $1.31 per hour worked. And this is assuming that there's a 50% premium, time and a half. Employees get time and a half basically for any overtime hours worked. You'd also have to factor in, if you had some double time hours, you would have to factor that into the rate as well. But basically the $1.31 is $25 per hour, your base wage rate, plus your half time premium times your 220 overtime hours, and then dividing that by your denominator, your 2,100 hours worked, to get your factor. Other premiums that could be in here would be things like shift premium as well. That hasn't been put in this illustration, but it's same type of format as overtime. Then you move down to pay for time not worked. Vacation, here we're assuming an average of 15 days. So on average, employees are getting 3 weeks of vacation time. So $1.43, again, it assumes an 8-hour day. So 8 hours a day times 15 days times your rate divided by your denominator of 2,100 hours worked gets your $1.43 per hour. So with holidays, we're averaging 10 holidays per year. So from a calculation perspective, it would be 8 hours per day times 10 holidays per year, which translates to 80 hours times $25 per hour, and then divide by your 2,100 hours worked, gets you your 95 cents per hour on the left-hand side. And it's basically a similar calculation throughout. Benefits, you've got your health care, and on average, we're assuming that the average cost per employee is $10,500 divided by your 2,100 hours worked, and that's $5 per hour. And this is a fixed cost basically. So, you know, your operating level, your operating pattern, the amount of your overtime that the employees are working has a pretty big impact on these fixed costs over time. For pensions, we're assuming a defined contribution plan with a 6% contribution rate. And so assuming that the pension contributions are based on eligible hours of 2,080, which is 40 hours per week times 52 weeks in a year times 6% times $25, divided by the 2,100 hours work, gets you $1.49 per hour there. Life insurance, again, we're assuming the premium for 2 times pay is $525 per year per employee, divide by 2,100 hours worked, gives you 25 cents an hour. And then disability and miscellaneous costs are I just put assumptions in that they're experience-based, so there are costs associated with those as well. Legals at the bottom, if you're in the United States, it would be things such as FICA or unemployment comp. Perhaps workers' compensation would be included in this as well, for a total of $3.50 per hour. So your all-in cost in this model is $40 per hour. That would be your going-in cost. Going into bargaining, your all-in cost would be $40 per hour. So if you look at the next column over the roll-up factor, the roll-up factor is really just a calculation, and the amounts are really a percentage of base wages. So for example, the first line there that has wage roll-up is overtime premium. So if you take the $1.31 per hour worked in overtime premium and you divide it by the $25 in base wage rate, you get a 5.2% roll-up factor. So, for example, if you increase wages by $1, you would increase your total cost by about $1.05 because of the roll-up just on that overtime premium. It would be 5% more. And then the same thing going down. Any of the elements that are effectively impacted by an increase in wage rate would have a roll-up factor associated with it. So, as you can see, fixed costs such as healthcare would not have a wage roll-up factor because it is not tied directly to the wage rate. Whereas in this case, pensions, it's a defined contribution program, so it would be linked to wages, and therefore there would be a roll-up factor. So in total, at the bottom of the page, you can see that the total wage roll-up factor is 37.8%. So any increase in base wage rate will have a 37.8% roll-up effect on labor cost elements that are directly impacted by that wage increase. So basically, for every $1 increase in base wages, it will cost you roughly $1.38 per hour worked. I would also like to reiterate that This model does not consider an inactive factor, so certain amounts should be adjusted for employees on inactive status who may qualify for certain payments and or benefits as well. And in addition, the model does not include any factor for retirees. So if you have any retiree costs, they should be factored into the model as well. The third and final step of the process to actually build the negotiations costing model itself. The easiest way to illustrate the development of a negotiations costing model is to look at an example. Accordingly, a model has been built utilizing the input models that we've previously discussed. First, we'll pull together the hours worked model, which assumes 500 active employees working 2,100 hours per year, which is a total of just over 1 million hours, 1,050,000 hours. And then coupling that with the going in labor costs, which we've seen earlier, that assumes all-in costs of $40 per hour worked. And in this case, we're going to assume a 3-year contract. Before we get into the illustration of the model, I'd like to talk about a couple of different concepts that are part of the model. The first one is continuation costs. Continuation costs represent the estimated incremental labor costs that an organization will incur over the course of the contract, regardless of whether or not any new economics are granted. So examples include the following: cost of living allowances, COLA formulas if applicable, because if you have a COLA formula that goes beyond the contract, you have to take account of those costs that will occur over the term of the next agreement, whether or not you change anything, unless you, of course, eliminate your cost of living allowance formula. But assuming you don't, those costs should go in there. Also, healthcare inflation. In the illustrative model we put together, we've assumed a 6% inflation rate on healthcare. And also cost increases associated with any changes in employee demographics, such as incremental wage costs as employees mature through wage progression steps, or incremental vacation entitlements as employees gain seniority. But from a practical perspective, many people don't put these types of elements in there, and they focus primarily on healthcare inflation and things of that nature. They're just trying to get a really, a good understanding of where you're going to end up in terms of costs. But it gets very complicated very quickly if you try to get every single element costed in this model. And it's also important to track these continuation costs separately from new economics. And it's good to highlight to the union that the company's labor costs will increase even without any new economics. Items like healthcare inflation can be pretty significant, and you'll see in the model that by the end of the contract expiration, almost $1 per hour will be your anticipated continuation cost just with healthcare inflation. So the point that you want to make to the union is that, hey, if we do nothing, just by virtue of having the contract, our labor costs are going to go up $1 per hour because of healthcare inflation. That's an important item to note. The next concept I'd like to discuss are new economics. New economics represent the incremental costs and or savings associated with modifications to the current terms of the contract. So these amounts are only included in the exit cost of the agreement if the contract modifications will continue into the next agreement. For example, things like base wage rate increases and healthcare coverage improvements. These are items that are permanently being added to your labor cost structure. On the other hand, conversely, one-time lump sum payments such as ratification bonuses or annual lump sums are included in the dollar summary, but not in the exit costs on a $1 per hour basis, as they would require renegotiation next contract. And finally, total all-in labor costs at exit should be measured against the aspirational targets established by senior leadership prior to the commencement of bargaining. These targets are often set based on a couple of different factors. One way to look at it is average annual increase in labor costs over the duration of the agreement, or secondly, dollars spent over the duration of the agreement. A couple different ways you can look at it. This next slide shows an illustrative example of a typical negotiations costing model. So keep in mind here that it's for illustration purposes only, and the key assumptions that we have in play here, it's a 3-year collective agreement. The hours are a consistent operating plan. Each year we have 500 employees working 2,100 hours annually each year for a total of 1,050,000 hours each year. So along the left-hand side of the chart, you'll see all the different elements. You've got your going in labor costs, you've got your continuation costs, so then you have your labor costs before new economics, and then you have your new economics, and we have several elements that we're laying out there, subtotal of new economics, and then at the bottom you'll have your total all-in labor costs. So you can see at exit in this example, labor costs are $42.85 per hour worked. So going in it's 40, so we've added $2.85 per hour. And we'll go through it in more detail in a little bit. It's a pretty busy slide, but it's important to understand how it works. So these dollars are recorded in thousands of dollars at the top. So you can see that we have total labor costs, year 1, year 2, year 3, and then we have a 3-year total. So if you're looking at the top line, going in labor costs, as you recall, it was $40 per hour. So in year 1, year 2, year 3, if you take the $40 per hour and you multiply it by the total hours worked for the company of 1,050,000 hours, that's how you get to the $42 million number per year. A total $126 million over the 3-year term. So that's your going in costs. Then the second line, we get into continuation costs. And remember, those are costs that continue in the agreement regardless of whether or not we do any modifications to the agreement. So in this case, we've utilized healthcare inflation as our one continuation cost element that we're going to look at. So in this case, we've assumed annual inflation for healthcare at 6% annually. And if you look back at our going in cost model, healthcare was $5 per hour. So it was $5 of the $40 total going in cost. So as you can see on the far right in the notes, year 1 year inflation on $5 at 6% is 30 cents per hour. So under year 1 in the millions of dollars category, you have $315,000 there, which is the 30 cents per hour in healthcare inflation times the 1,050,000 hours worked. Then you have to stack year 2. So year 2 would be the $5 in your going in costs plus the 30 cents from your year 1 inflation. So your base for year 2 is $5.30 at 6% gives you 32 cents an hour. So then you have to take the 32 cents an hour plus the 30 cents an hour for the first year for 62 cents an hour in total times your 1,050,000 hours worked per year gives you a year 2 total that stacks of 651,000. And then the same thing occurs in year 3. Year 3, you've got 30 cents of inflation in year 1, you've got 32 cents in year 2, so your year 3 start is $5.62 times 6% is 34 cents. So that stacks on top of the 30 and 32. So that's how you get the 96 cents per hour that's in your labor cost per hour, the first column there, and that's worth $1,008,000 in year 3 of the contract. So the 96 cents is really just looking at your inflation from year 1 at 30 cents, year 2 at 32 cents, and year 3 at 34 cents. You have to stack those values in order to get the proper value. So it's important to note, especially if you're talking to the union, that even if you do nothing in this contract, in terms of new economics, there's almost $1 per hour that you're adding to your labor costs as a result of healthcare inflation. So now we'll turn our attention to new economics. The first line under new economics is a ratification bonus of $1,000. So if you look in the notes side, the $1,000 bonus for 500 employees is basically a year 1 cost only. Therefore, it's not included in labor costs at exit. So under the labor cost per hour column, you will not see any value there because it's a one-time payment and it's not permanently adding to your labor cost structure. The other thing to note here is, while it's not included in this illustration, if you did have an inactive elements to your workforce, if you had, say, 5% of your workforce that were on sickness and accident or on disability of some sort, any type of inactive status, those amounts would have to be included in the millions of dollars here as well. So if you had a 5% inactive factor and a ratification bonus language suggested that they should be paid, then it would be $525,000 in that first year 1 column rather than $500,000. The next 3 lines represent the wage or the economic increases inherent in the agreement. So in year 1, the company is providing a 3% general wage increase. In year 2, they're providing a $2,000 one-time lump sum. And in year 3 of the agreement, they're providing a 2% general wage increase. So let's look at the year 1 general increase of 3%. So on the far right in the notes, you can see if you take your $25 per hour, multiply it by 3%, it gives you 75 cents per hour. Then, of course, as indicated before, we have to add the roll-up factor to take into consideration things like overtime and defined contribution pension that's going to increase. So the actual cost of the company with roll-up is $1.03 per hour worked. And that's what you see in the column under labor cost per hour, $1.03 per hour worked. And then naturally, if you look to the right under your total labor costs, that's going to occur year 1, year 2, and year 3. So in all 3 of those years, you'll see almost 1.1 million in additional dollars spent over the term of the contract. And then year 2, you can see the $2,000 lump sum, and that's basically $2,000 times 500 employees, which is a year 2 cost only. Therefore, it's not included in labor costs at exit in the column under labor costs per hour, since it would have to get renegotiated next year, similar to the next cycle, similar to the ratification bonus. And then under year 3, with a 2% general wage increase of 71 cents, that's a year 3 cost of $749.5 million. And in this case, you have to take the original going in cost of $25 per hour, add in the 75 cents per hour that was part of your year 1 3% general wage increase. So your new base for calculating the incremental cost would be $25.75 per hour times a 2% increase is a little over 51 cents per hour. Again, multiplied by the 1.378 roll-up factor, give you 71 cents per hour worked. And then in the millions of dollars over in year 3, you'll see roughly this, approximately 750,000 when it gets applied to the 1,050,000 hours worked in that particular year. The next economic item is the fact that the union negotiated improvements to healthcare coverage, and assuming a cost increase of approximately $525 per employee, that relates to 25 cents per hour worked. And since it's permanently going to add to your labor cost structure, that gets included in your exit costs under your labor cost per hour at 25 cents, and that value is then included in terms of the millions of dollars in years 1, 2, and 3 as well, because those will continue on. Finally, disability insurance, assuming that the company is able to negotiate an increase in the waiting period for sickness and accident insurance from 3 days to 5 days, that's an example of a decrease in your labor costs. And assuming a 10 cent per hour decrease, you can see that your labor costs on the millions of dollars part of the chart is going to decrease by 105,000 per year. So as you can see, this negotiations costing model is an excellent way to both track and cost out the value of the agreement that is in place. Just in summary, your labor costs going in were $40 per hour, and at exit, they're at $42.85 per hour worked. The average annual increase going from $40 to $42.85 over a 3-year period is 2.3% on average. Your labor costs are going up, and that 2.3% average annual increase, 0.8% of that is just due to healthcare inflation alone, and then the other 1.5% is a result of the new economics of the deal. So in total, if you look at it, the total new economics in terms of millions of dollars, it's approximately $6 million that is being put on the table here for the new agreement. So again, it's a good model to use to help you cost out the value of the agreement, and it's an excellent tool to provide to your finance teams for purposes of forecasting labor costs over the next 3 years. The next topic we're going to talk about is bargaining tools. There are a number of bargaining tools that can easily be developed in order to, 1, improve costing efficiencies, secondly, assist in the formulation of bargaining strategies, and thirdly, assist in the development of economic offers. The following examples of bargaining tools will be discussed in this module. The first one is building blocks, the second one is migration charts, and the third one is demographic analysis. Building blocks represent the development of predetermined costing scenarios relative to anticipated union demands and/or management proposals. These costing scenarios are typically calculated based on a simple unit of measure, for example, a $1,000 lump sum or a 1% increase in wages, so that multiples can be easily extrapolated. So if you have the multiple for 1,000 and the union is demanding 3,000, you just take the number you've already calculated and multiply by 3. It's as simple as that. These building blocks should be developed by subject matter experts in conjunction with the labor economics and finance teams. In many cases, the areas such as pensions and healthcare are developed with the assistance of actuaries. Typical examples of building block elements include the following, and these are based on the previous costing model we developed earlier. A 1% increase in base wage rate is 35 cents per hour worked, including roll-up, or $364,000 annually. Good rule of thumb to have. $1,000 lump sum is equal to $500,000, and that can be used whether it's a ratification bonus or as an annual lump sum payment. One additional holiday is equal to 10 cents per hour worked, or $105,000 annually. 1 percentage point increase in the deferred contribution pension formula equals 25 cents per hour worked, or $260,000 annually. These quick rule of thumb calculators are excellent bargaining tools. They can be utilized by multiple users, including labor VPs, subcommittee chairs, and even the labor economics and finance teams. They provide a high level of certainty when required to quickly cost out demands or proposals, and they're an excellent reference tool for bargainers while engaged in discussions with the union. You can immediately assess the cost implications of certain union requests. So if you're in the middle of a subcommittee meeting and the union demands something that sounds like it could be expensive, you can refer to your building blocks and quickly decide whether or not to engage them further or to push back. The second bargaining tool I'd like to discuss is migration charts. Migration charts should be prepared by each subcommittee. Typically, they're prepared well in advance of the beginning of bargaining, and the charts visually depict the current state with a migration plan to move to the ideal state or target, presumably identified through benchmarking. The chart in this slide illustrates an abbreviated example of a matrix that would be developed by perhaps the benefits subcommittee. In the case of the proposed healthcare cost share modifications noted below, the benefits subcommittee would develop proposed healthcare plan design changes along with estimated cost savings, as well as modified contract language to support the various steps. So you do one for 15%, 20%, and 25% cost share scenarios in this case. This information is then utilized to assist in the preparation of economic offers. The ideal state may be presented in the first offer, while migration steps 1 and 2 would be considered as potential fallback positions. The ideal state doesn't necessarily mean where you want to get today, but it's a target for something perhaps 1 or 2 bargaining sessions down the road. It's a good planning tool to have. And basically all of the different subcommittees would prepare charts exactly like this. So for bargaining strategy purposes, each of these charts would be looked at and consolidated for potential economic offers. The third bargaining tool that we're going to take a look at is demographic analysis. Demographic analysis, such as the development of an agent service grid, provide valuable insights that can be utilized to formulate the overall bargaining strategy. Different employee cohort groups may have different desires. For example, younger employees may be more interested in wage growth, while older employees may be more interested in pension improvements. So it's important to take a look at both groups. Also, economic offers may need to appeal to a variety of interests in order to achieve a ratified agreement. The other thing I would recommend in doing these agent service grids is doing one for non-skilled employees and one for skilled employees. Or if you have other groups of employees that are distinct from each other, it makes sense to look at them separately. And also, it's good to look at the people who are retirement eligible. As noted in this graph, it looks like there's 246 or 30% of the total population are eligible to retire. If you're contemplating any restructuring actions, or if you're trying to change the composition of your workforce and offer retirement incentives, it's very important to have this information at your fingertips. So this is a great tool for bargaining. We're now going to move on to bargaining strategy formulation. Bargaining strategy is typically formulated by taking numerous factors into consideration, including the following: company goals and objectives, including both financial and non-financial targets, union goals and objectives, the economic environment, and overall competitiveness in terms of either wages and operating metrics such as productivity, quality, etc. And benchmarking is always important in this case, as mentioned earlier. We're going to review 2 key tools that can provide guidance with respect to bargaining strategy formulation. The first one is a union versus management objectives matrix, and the second one is an offer playbook. The union objective versus management objectives matrix is an excellent bargaining strategy tool. For anyone who's been involved in union negotiations in the past, you're fully aware of how overwhelming the process can be. It's not uncommon for the union to present a company with dozens, if not hundreds, of demands. The trick, of course, is to tease out the demands that are really important to the union and to find a way to set aside frivolous demands that are nothing more than distractions. There's really no one way to identify the demands that are of utmost importance to the union, but there are some thoughts on how to tease them out. One thing you can do is look at recent industry settlements. They may provide clues of what the union is either looking for or willing to accept. Also, during daily roundup meetings with the subcommittee chairpersons, ask the subcommittee chairpersons what specific demands are routinely raised or referenced by their union counterparts. Listen for recurring themes that seem to be common across multiple subcommittees. And also, you can just simply ask the union what is most important to them. Often they will give you some pretty good insight, as in many cases the unions are required to bring forward any demands that were solicited by their members. Once the union's key bargaining objectives become more clear, it's beneficial to create a side-by-side matrix that juxtaposes the union's objectives with management's objectives similar to the one below. This simple tool will assist the senior members of the bargaining team in focusing in on the more important union demands and potentially aligning these demands with management's objectives in order to create win-win solutions. The union and management objectives do not necessarily have to be really specific. They can be very broad-based. In fact, in many cases, I've found that the more broad-based the definition of the objectives, the more flexible and creative the solutions tend to be. So the table is an illustration of an abbreviated side-by-side matrix. In practice, you really want to focus on the key bargaining objectives, so the number of elements would likely not exceed 5 or so key themes. So in this case, we've outlined 3 key union objectives: new economics, no financial concessions on benefits, and also they're looking for investment commitments. Key management objectives, on the other hand, looking for a moderate level of new economics. Management wants to reduce absenteeism, and also they want to mitigate rising healthcare costs. This high-level matrix can be utilized to facilitate brainstorming sessions with the union in order to facilitate win-win situations. A couple of examples are as follows. 1, management can acknowledge that it understands that the union desires new economics, that the company is willing to improve the standard of living for their members. However, management needs to address high absenteeism. Again, that quid pro quo from the side-by-side matrix. So perhaps a component of the new economics package could include an annual attendance award. A second example, management objective is to mitigate rising healthcare costs while the union is demonstrating resistance to any financial concessions on benefits. Again, perhaps the parties can brainstorm ideas where the quality of healthcare and out-of-pocket costs of employees are relatively unchanged, but may require union members to adopt more of a consumerism attitude in order for the company to reduce costs. A couple of examples may include, plan design changes that may require generic drugs versus brand name drugs, or reference-based pricing initiatives where employees are directed to lower cost delivery models for certain procedures and services. Again, I think this is an excellent bargaining strategy tool, and it's quite capable of identifying win-win solutions. The second bargaining strategy formulation tool is the development of a playbook of economic offers. A playbook of economic offers should be developed well in advance of bargaining. In my experience, 3 or more offers are typically tabled prior to reaching a tentative agreement. The cadence of offers largely depends upon individual circumstances and preferences. In most cases, first offer is not tabled until all the subcommittees have met for a week or two, and when both union and management have a clear understanding of each other's expectations. This is an important point because the last thing you want to do is to surprise the union with an offer that introduces elements that come out of left field. The first offer must be very well thought out. It should send a message but should not be insulting. If the first offer is considered insulting by the union, it is like a first impression. It is very difficult to overcome, and not only will it create animosity early in the bargaining process, it may make ratification more challenging should the union members become aware of the initial company stance. In addition, it should be noted that in pattern bargaining situation, the union may want to receive first offers from all companies prior to selecting a target company. The below is the abbreviated playbook of economic offers. Obviously, there's no limit to the number of elements nor the number of offers that can be presented. Also remember that nothing in negotiations ever goes exactly as planned, so look at this as a strategic tool and recognize that the offers will need to be tweaked as necessary throughout the process. The best source of information for developing the playbook are the migration step matrices developed by the subcommittees and the labor economics or finance team as outlined earlier. So as you can see, the chart on the slide illustrates what a typical playbook would look like. In this case, there are three separate offers. The first offer, second offer, then the third offer. So if you take a look down the left-hand side of the chart, there are a number of different elements, and it could be a whole slew of elements. It could be 10, 15, maybe even more elements that are part of these offers, but this is just an abbreviated version. So in the first line, ratification bonus, the first offer, perhaps it's $500, second offer, $1,000, third offer, $1,500. These numbers would typically go up as you move closer to the contract deadline. The second line is kind of a base wage increase in year 1, year 2, and year 3. And as you can see here, for illustrative purposes, typically early on in the process, you would offer less in terms of base wage increases and more, as you can see, the next line, in terms of lump sums, because typically with companies, they would prefer to provide lump sums to employees rather than base wage increases. So that's how this has been kind of laid out. And as you can see, as the offers get richer as you move from first to third offer, the amounts increase as we go along, and we're shifting from lump sum payments up to perhaps base wage increases as needed. And then the next line, healthcare, you can see it's these numbers are consistent with what we laid out before in the migration strategies from the subcommittees. So you might start off high, 25% I believe was our ideal state, and then kind of moving down to 20%, and then 15% is kind of where you kind of hope to end up at. And then it's always a good idea to lay out memo form anyway what the 3-year cost of those separate offers would be, so that you get an idea of what the successive values of these offers are. So as mentioned earlier, nothing ever goes as planned. This is just a playbook. You have to adjust these amounts on the fly, but it's always good to have a plan. And in addition, these types of offers would be approved by the review committees or the internal governance committees and so on in advance, but then at each step as you present a new offer, these should be approved by senior leadership. So the next slide is a summary slide of the bargaining preparation strategy formulation module, and the main points I want to address here is just it's never too early to begin bargaining preparations. That's one of the key points here. It can start 12, 18 months in advance. Just at a high level, you can start looking at strategy. Secondly, utilize the 3-step approach in developing your negotiations costing models. It works well. Looking at the hours worked, then developing your going-in costs, and then developing the model based on the best available information that you have at your fingertips at that time. Also, bargaining tools can assist in saving you time and reduce stress throughout the process if you have them prepared ahead of time. Brainstorm multiple scenarios when developing proposed offers. It's always good to give senior leadership options. It can be any number of mixes between base wage increases and lump sum payments, maybe some variable compensation in there, but give them options. And it's always good if you're looking at a certain level of compensation or offer, $3 million, give them 2, 3, 4 different options of how you could do a $3 million offer. So it's the more scenarios you can create, the better. And again, finally, look for win-win solutions. It's always easier to get things ratified when there's something in it for the employees as well. Thank you for taking the time to participate in our on-demand webinar today. I am pleased to inform you that HR and Labor Guru has 3 distinct on-demand webinar series with a total of 7 modules as follows. First, we have the Reduce Your Labor Cost series, and there are 2 modules in this series. Secondly, we have the Bargaining Preparation series, and again, there are 2 modules in this series. And finally, we have the HR Analytics series, and there are 3 modules in this particular series. I would like to take a few minutes to talk to you about the content in the respective series. In a few instances, certain strategic concepts are introduced at a high level in one module, and then for those of you who are interested, presented in a deeper dive format in another module. I will attempt to highlight these situations as I quickly walk you through the module highlights. First, let's talk about the Reduce Your Labor Cost series. These modules will appeal to anyone interested in reducing their labor costs, whether you're an HR or labor professional looking to redesign your compensation and benefit plans, preparing for negotiations with the union, or simply a corporate controller looking for opportunities to reduce labor costs. Part 1 of the Reduce Your Labor Cost series deals with compensation and workforce composition. In this series, you'll develop an in-depth understanding of the numerous financial elements that should be considered when calculating all-in labor costs. Also, you get an understanding of several internal and external factors to take into consideration when contemplating modifications to compensation. Also, compare and contrast employee or union versus company preferences with respect to compensation alternatives, to recognize strategic opportunities to offer lump sums and/or variable compensation versus fixed wage increases. And finally, in this module, you'll obtain a clear understanding of how changes to a company's workforce composition can be one of the most union-friendly opportunities to significantly reduce and/or mitigate rising all-in labor costs over time. In contrast, Part 2 of the Reduce Your Labor Costs series deals primarily with healthcare, pensions, and other employee benefits. In this module, you'll gain an appreciation for the importance of plan design decisions in driving overall employee healthcare costs. You look at things like employee cost share, delivery models, and clinical programs. Also, you look at the identification of the multiple levers, strategies, and tools available to mitigate rising healthcare costs. Also, we'll take a look at a three-step analytical approach to identify key focus areas in order to facilitate potential cost reduction strategies for healthcare. And also, we'll have a comprehensive strategy to address high-cost healthcare elements using a reduce model. And we'll also take a look at developing win-win healthcare solutions for both employers and employees or their unions. In addition, you'll understand cost mitigation strategies for other employee benefits, including pensions, disability, life insurance, paid time off, and retiree benefits. And finally, we'll learn about proven strategies aimed at reducing other post-employment benefit obligations and costs related to retiree benefits. Secondly, let's talk about the bargaining preparation and strategy formulation series. These modules will appeal to anyone looking for practical guidance relative to preparing for bargaining with the union, whether you're a member of the actual negotiations team or a member of one of the support teams, such as finance or public relations. Most of the content, particularly with respect to strategy formulation, will appeal to all levels of an organization, including directors and vice presidents. Part 1 of this series is called Bargaining Preparation. This module outlines the key negotiations preparation activities that should be performed from 12 to 18 months in advance of bargaining right through to opening day. The key areas of focus for bargainers typically include the following: a bargaining environment assessment, development of a robust internal governance process, development of negotiations costing models, formulation of bargaining strategy, and finally, creation of a comprehensive communication strategy. And all of these elements are dealt with in this module. While negotiations, costing models, and strategy formulation are presented at a high level in Part 1, for those of you interested in more of a deep dive, I would highly recommend looking at Part 2 in this series as well. Part 2 is called Negotiations, Costing Models, and Strategy Formulation. In this module, you'll develop an in-depth understanding of the numerous financial elements that should be considered when calculating all-in labor costs and creating negotiations costing models. You'll also obtain a clear understanding of how to develop a dynamic cost model by utilizing a simple three-step approach. In addition, you'll learn how to develop practical bargaining tools that can be utilized to improve efficiencies when costing out union demands and management proposals, develop alternative economic offers, and assist in formulating overall bargaining strategy. As well, you'll learn how to develop a simple matrix that will assist the company in identifying potential win-win solutions with the union. And finally, you'll understand the importance of developing a comprehensive economic offer playbook by consolidating input from the various subcommittees. And finally, let's talk about the HR Analytics series. These modules will appeal to a wide variety of professionals, including those in the analytics, finance, HR, and labor relations fields. Part 1 of this series is entitled Building a Value-Added HR Analytics Function. In this module, you'll take a look at the structure, roles, and responsibilities of an effective HR analytics team. We'll also talk about how to address common challenges that companies face in growing their HR analytics function. We'll identify quick wins and value-added projects that will appeal to both HR business partners and HR centers of excellence. And finally, we'll take a look at an introduction to predictive analytics through an illustration of a 6-step process. Part 2 of the HR Analytics series is called Breaking the HR Analytics Paradigm. We're going to be looking at hourly workforce data. First thing we're going to look at is recognizing the low-hanging fruit associated with the examination of hourly workforce data. We're going to focus on operational and cost savings opportunities associated with three distinct areas. First, absenteeism, including Family Medical Leave Act in the United States. Secondly, the hourly hiring process. And thirdly, hourly employee payroll data. And the final module in this series is part 3 that deals with healthcare analytics. We're going to gain an appreciation for the importance of plan design decisions in driving overall employer healthcare costs, look at things such as employee cost share, delivery models, and clinical programs. In addition, we're going to look at the identification of multiple levers, strategies, and tools available to mitigate rising healthcare costs, and also we'll have to do an in-depth understanding of a 3-step analytical approach to identify key focus areas in order to facilitate potential cost reduction strategies. And we'll also look at a comprehensive strategy to address high-cost elements utilizing the reduce model. And the idea here is to develop win-win solutions for both employers and employees and their unions. Thank you for your time. I hope that these webinars provide you with valuable guidance and practical solutions in addressing the many HR and labor challenges facing your organization.